Welcome everybody. My name's Lee Jobling, partner of our Investment Advisory and Wealth Division here at TAG Financial Services. I head up the division with Michelle Griffiths, who's also one of the key people and key advisors that work very closely with our clients to help them achieve their financial goals. We say investment advisory and wealth because the financial planning industry, we like to distinguish ourselves from the rest of the industry in that we believe that we're working closely with our clients on their personal financial needs and objectives and helping them develop strategies to achieve what's important to them and their families. Financial planning, I think, has traditionally been about investing, which insurance policy, having the right super fund, and we do those things, but what's most important is the outcomes for our clients. And those financial products, I guess, are simply a means to the end. A couple of weeks ago, we ran an information session here in the office, and it was an investor update. So what we wanted to do was share a little bit of that content with you now. We covered the budget, some of the changes that were announced in the budget. We covered off on some of the superannuation changes that are coming through on the 1st of July. And we also spoke about our principles and philosophies as we advise our clients with an investor update. But what I wanted to focus on at the moment was a part of the presentation which we did, which was an economic update. So this is designed to give you guys a little bit of insight into where the Australian market and economy is at the moment, what's some of the trends that are going on overseas, but most importantly as an investor, what that means to you as you're making decisions about growing your wealth, how you invest, and navigating your way through some of the noise. Naturally, any information today is general in nature. What we do offer anyone that's interested is a complimentary meeting where we can come in and have a chat about some of this stuff and see how it relates to your personal circumstances and how you can apply it to your benefit. But this is not personal advice, and you should seek advice before acting on any of this information. So some of the economic themes in Australia at the moment are one of low growth and low inflation. The Reserve Bank is targeting growth rates in Australia, or would like to see growth rates of around 3 to 4%, and at the moment we're going along at sort of 2 to 2.5%, and target inflation is also around the sort of 3.5%, and we're moving along at the moment at about 2%. Some people get concerned about inflation. That means prices going up. Look, inflation is a good measure between the tension between buyers and sellers. So when we think about economic concepts and who is in the marketplace to buy a particular product and the producers and the sellers of those products, we need to make sure that there's a sensible balance between supply and demand. If demand is low, then goods and services aren't moving through the economy effectively. And if prices are too high, consumers put their wallets away and aren't prepared to spend. So a sensible level of inflation just makes things are moving forward in a sensible way. So growth and inflation are certainly below the Reserve Bank targets. Naturally, one of the key levers to stimulate growth and make sure inflation is within sensible levels is how we manipulate interest rates. And the Reserve Bank at the moment has a cash rate of 1.5%. I guess for home loan borrowers, that's probably translated into mortgage rates of somewhere between sort of 4 to 4.5%. And for those with term deposit, it's not very exciting. We're probably struggling with sort of 2.4, 2.5% off term deposits at the moment. But low interest rates are a way of stimulating the economy. There's no point leaving money in the bank. It's not doing much. But also, in terms of borrowing money, we're able to borrow money at low rates, and that stimulates housing, that stimulates expenditure, and helps services and products move through the economy. So in terms of interest rates, we're certainly not expecting interest rates to move in Australia in the next 12 months. I don't know that we'll see too many more rate cuts. I would have thought that the Reserve Bank will probably hold rates where they are for the time being. Some of the other things that we keep an eye on are unemployment levels and wage growth. So although Australia's unemployment is not a bad number at around 5.7%. It's probably just ticked up a little bit over the last 6 months. Australia is generating jobs, which is fantastic. What has contributed to that increased unemployment rate is more the participation rate. So we're seeing, school leavers, and with immigration and growth in population, we're seeing more people out there looking for jobs. So although we're creating jobs, we're not creating them at a rate fast enough to keep up with the demand for jobs. And what that is translated also to is fairly low wage growth. So wages haven't moved much in Australia or internationally for that matter for some years now. Most employees have been more than happy if their wages are kept up with inflation, and that's about where things have been at for a period of time now. Wage growth and unemployment levels, again, the tension between demand and supply, employers and employees, jobs and people seeking, is one of those things that the Reserve Bank monitors. With those low interest rates, again, there's an expectation that businesses will spend, businesses will invest, businesses will borrow and grow, and that should maintain unemployment at sensible levels, but at some point introduce some wage growth. Generally, there's been improving business confidence. I think businesses in Australia have come to grips with changes off the back of the global financial crisis, and they're starting to understand a lot more around debt levels and positive cash flows, and what it means to run a robust business without getting ahead of ourselves. Too many businesses pre-GFC were focused on growth at all costs. I think now businesses have stripped out a lot of surplus cost, and they've improved their profits and their profit margins. That has driven share markets to a degree. It'll now be interesting to see, as costs have been stripped out of businesses, whether they're able to grow their top line as well. So some industries are struggling to grow their revenues, and some businesses, probably in the technology, education and some of the other industries that are doing not badly in Australia, are able to grow their revenue. But with the reduction in cost driving profit, now the markets will look for new catalysts to drive company profits, and that'll have to be at some point revenue growth. You can only reduce costs so far. Stabilising commodity prices, iron ore, oil, coal, these things have bounced around a fair bit. Were high pre-global financial crisis, crashed post-financial crisis, but we have seen stabilised prices over the last 12 months to 2 years, which has assisted our markets over here, particularly the resource companies, of course. Rising house prices is an interesting one. Look, we don't probably expect to see any house price crashes. Got to say though, slightly concerned about those low interest rates at the moment. People are highly leveraged, households are highly geared, and a couple of percentage points increase in home loan interest rates will cause cash flow problems within households, and it's probably inevitable that translates at some point to people not being able to afford to keep their houses anymore, not being able to keep up with mortgage repayments. Housing prices, I guess, have been driven by downsizers. So people with higher value properties have money to spend as they buy something slightly smaller and slightly cheaper, I suppose, but they are driving up the prices of those lower end properties. And then we got upsizers, so the people that have enjoyed some price growth in their more modest house looking to get into the next suburb, at a higher value, so able to take on the debt to accommodate that. So those things have driven house prices. I know the government is concerned and the RBA is concerned about house prices. That does come into their decision around low interest rates, but I think the priority is to get the economy off the deck as opposed to necessarily winding back house prices too much or making sure house price doesn't get too far out of control. The other thing with the Australian economy at the moment is our dollar is reasonably high versus some of the international currencies. We're currently at around 74, 75 US cents. Most of the analysts out there believe our dollar probably isn't worth much more than about 65 US cents. With our higher Australian dollar, That's a concern for governments. Our government would certainly prefer a lower dollar. That would mean that we're more competitive on the international stage. So our products and services that we export to the world become cheaper to buy for the overseas purchaser in Australian dollars. So a lower dollar is certainly better for our economy. Doesn't necessarily help those of you that were looking to travel overseas, but in terms of our exporters and certainly in terms of international travellers coming to our shores and stimulating our economy, it is a very positive thing. For those clients of ours that have a diversified portfolio, having exposure to international shares is something of interest. We would always have some exposure. However, the prospect of a falling dollar does assist with the opportunity to leverage off that potential prospect to generate higher returns from investing internationally. So I think it's always important to have a broad range of assets across a range of different areas. Diversification is most important. However, we're seeing that there's an opportunity to invest internationally and pick up the benefit from the fall in the dollar. From a market point of view, this is a graph of the All Ordinaries Index going back to the late 80s. And you can see that naturally the market got ahead of itself around 2007, 2008 with the mining boom, probably over-adjusted in 2009 to 10, and then it's sort of just started to trend higher since then. You'd look at that and go, look, the Australian share market really hasn't done anything or achieved much in the last 7 to 10 years. And that would be fair to say if we were just looking at the All Ordinaries Index. But it's important to remember that returns from shares are partly growth, and the All Ordinaries Index is a reflection of the company share prices, some of those. What's most important though is the accumulation index. And what that does is it takes into account not just the sum of all the share prices on the market, but it also takes into account dividends earned. And you'll see those same highs and lows through 2007-8, 2009. But what you'll see is that with dividends that have been earned on Australian shares over the last sort of 7 to 10 years, those that were able to hold their shares and maintain their nerve through a fair period of volatility have come out well ahead, both through the improvement in the price of the shares or the value of the shares, but also the dividends that they've received from the shares. During the GFC, Commonwealth Bank got down to around $30. It's back up to about 80 odd. But it's been paying roughly a $2 dividend every year for the last 8 or 9 years. So even though the share price was under pressure, there was certainly the company profitability was still there, and distributions and dividends were maintained. Overseas, naturally, there's been a lot going on politically. You've got Trump being voted in late last year. He's come into power. I guess a lot of that now markets are looking for is Trump able to get a lot of his policies through. A lot of his policies, and particularly his intentions around infrastructure spend, stripping out red tape from business and allowing businesses to be a little bit more dynamic and less wrapped up in paperwork and red tape, is generally a positive for markets. That should improve company profitability, and naturally at the end of the day, share markets are really only a product of all the company profits and their share prices. So anything that contributes to company profitability is a positive for markets. But markets will be looking for Trump to get some of his policies through, and I guess we just wait to see how some of that pans out. We've had a reasonably recent French election as well, where Macron, the independent, came through. Well, he wasn't independent, but it's funny how he pretty much created a new party for himself, but came through and won the French election. But he was more about stability than Lepage, his counterpart, who was more about leaving Eurozone and would have created more instability. So Macron coming in has certainly been a positive for European markets. You've got German market doing quite well. Production numbers are up there. But some of the other economies, Spain, Portugal, some of those are still struggling to get off the deck. 25% youth unemployment and all that sort of stuff. So it's interesting to see how that goes. They're still pumping a lot of money into the economy through quantitative easing. which is really just sort of putting money into the economy to stimulate growth. What we were concerned about was what would happen with the US as they reduced their quantitative easing, but the markets responded quite positively, and I think that we're seeing that the US economy is able to stand on its own 2 feet without that false injection of money, that temporary injection of money, which was really only designed as a short-term measure, which did last many, many years in the end, but the economy certainly seems to be standing on its own 2 feet. Interest rates are going up, unemployment is down, their unemployment rate is under 5%. As far as everyone's concerned, that's pretty much full employment. It's really those that probably shouldn't be getting a job, or people that are going to struggle to get a job under any circumstances are pretty much the only ones without one at the moment. Housing starts are up, and confidence across consumers and business is all heading in the right direction. Over in China, they're still ticking along at 6.5%. No, it's certainly not the 9s and 10s that they experienced 7, 8, 10 years ago, but 6.5% is still not bad for an economy that's still urbanising. I guess people sort of coming off the farms and from the countryside into the cities, so they're still growing at a reasonable rate, and we've got countries like India nipping at their heels as well that are going to come through as the next growth story. So there's always going to be a lot of noise. What's going on with the UK, what's going on in Europe, what's going on with Trump, there's obviously issues over in North Korea and all the rest of it, but I guess from a investing point of view, what we try to keep clients focused on, again, is their end goals and objectives, and we try to invest around that to make sure they've got the cash flow and the income to meet their needs today, but also be providing sensibly for their future. Our job is to make sure our clients are financially secure for the rest of their lives, and they're even planning for the financial security and the legacy of their children. This is the volatility index. So as you can see, that's for the last 10 years. Back in 2008 there, naturally GFC was quite high. You had things, other events like the Greek defaults and conjecture about whether they'd leave the Eurozone. Naturally last year we had the UK with Brexit voting to leave the Eurozone. But again, for us, I think we'll find that the UK will renegotiate their trade agreements with other countries, and it'll be a business as usual for the UK. How easily money flows around the Euro and Eurozone and with the UK will be interesting. However, I think the way that markets have stabilised in the UK economy and the market has continued to grind higher would suggest that no one's expecting anything catastrophic to come of Brexit. This is the volatility index. As you can see over the last few years, we're certainly in a period of low volatility, so markets are seeing a lot of stability. There's a lot more confidence around investing. There's not a lot of triggers around at the moment that would create any major concern around continuing to sensibly invest and build portfolios. We would always exercise a level of caution about how much people invest all in one hit, but certainly we can navigate our way through that. But there's not a lot of news around to suggest we shouldn't be quietly optimistic about the 5 to 7 to 10 year outlook. There's always going to be a lot of noise. There's always going to be a lot of things that get us distracted from our end goal. But what's most important is focusing on what you are trying to achieve, what the end game is, what are the outcomes that are important to you, and make sure that you weigh, you invest, and you run your financial lives is completely in sync with that. If you'd like to join our mailing list, what that will entitle you to is we send out on the email from time to time some tag tips, so little legislative updates or bits of information that might be relevant to you, and budget updates, things that come through in May and June. These types of webinars, we're able to make sure that you're invited along to those and get little 10 and 15 minute bits of information that might be useful. And we also run information sessions in the office here for up to 30 people at a time on different topics: estate planning, investing, superannuation strategies, investing in property, and like topics around financial matters, and that's pretty much a more the merrier type thing. That's an open door to, if you'd like to come along or bring anyone that you think might be interested, more than welcome for you guys to come along. Okay, that concludes our webinar. Hopefully you've received some useful information from that. If you would like to take advantage of a complimentary meeting to have a chat about your personal financial situation and what you can do to improve that or build towards the future or plan for retirement or whatever your thing may be that you would like to focus on, then contact one of our advisors and we'd be happy to catch up with you. TAG Financial Services is a full service company. TAG stands for Total Advisory Group. So we're more about providing value-adding advice to assist clients achieve their goals. We do compliance work, we do investing, we do lodge a tax return, we do those things, and they're important, but if we can work with you to achieve a better outcome for you and your family, that's certainly our main objective. Thanks for listening and have a great day.